Welcome to the Broken Pie Chart Podcast. I'm your host, Derek Moore, and this is episode number 107. All right, so this week we're going to talk a little bit about the U.S. dollar. Why should you care whether the dollar is weak or strong? And is the U.S. dollar index the best way to sort of keep track of how strong or weak the U.S. dollar is? There's another one called the trade-weighted U.S. dollar index that I'll kind of explain as well. So what is the U.S. dollar index? Okay, if you know this already, then this will be a quick refresher. But it's a basket of currencies. And when we say currencies, unlike a stock, you buy IBM, and if it goes from 100 to 101, it went up. It itself went up, not relative to anything else. But currencies are normally quoted as a pair, as a relative basis of value one against the other. So, for example, if the euro / US dollar, EUR / USD, is currently, 1.13, what does that mean? What that means is it's always the second one after the slash. It's how many of those do you need to get one of the other. So you need 1.13, $1.13 to get 1 euro, if that's the exchange rate. If it's the other way around, let's say it's USD, US dollars / JPY, which is the Japanese yen. If that's quote, I don't even know what it's trading at right now, but if it's, let's say it's about 110 or so, that means you need 110 Japanese yen to get 1 US dollar. And so when they're traded or quoted as a pair, and they're not always quoted that way. Sometimes they flip it around. In fact, if you've ever traveled internationally and done a currency exchange, you go up to that booth at the airport, and please don't change your money at the airport unless you absolutely have to. The spreads are really wide. The fees are high. That's your public service announcement. But sometimes they flip it around. And so it will be, USD / EUR. And you're like, well, how do I read this? Well, you might need 80 something cents, 0.86 of euros to get $1, that type of thing. So, but what they do is the US dollar index is a basket. And so the value of that basket goes up or down depending upon how the US dollar is doing versus a basket of currencies. Now, the US dollar index, as it's set up today, it's pretty Eurocentric. And so I checked real quick in the current weights. The US dollar is against the euro, roughly 58%. The British pound, about 12%. The Swedish krona, a little over 4%. Swiss franc, just under 4%. And then really, the only, I'll call them non-Eurocentric currencies, the Canadian dollar, a little over 9% weight, and the Japanese yen, about 13.5%, maybe a little bit more than that. And so much like if you bought a basket of stocks, some of the relative, if you were looking at Japanese yen against the US dollar, maybe the yen is strengthening, so the dollar is weakening, or maybe the dollar is strengthening against the British pound, which means the British pound is weakening. So it's an index, right? And it goes up or down depending upon, what all of those are. Now, some people point out that, hey, wait a second, what's missing in here? What about China? What about Mexico, especially, in the U.S., right? What about, Brazil or other countries? And so you could have a situation where maybe the U.S. dollar is going up or down against these currencies. And let's face it, it's very Eurocentric. The euro is almost 58%. But is that really the best measure? So one thing that I think it's the Fed, I don't know if the Fed came out with this or who, I should have looked this up, who sort of created this. But they created a trade-weighted US dollar index. And so basically it looks at all the trading partners, your imports, your exports, and it tries to see, okay, so instead of using those weights, let's go ahead and look at who we trade with, who we, meaning the US, and we're going to weight those currencies. So, for example, in the trade weighted one, I believe these numbers are correct still. For start of the year, Mexico is just under 14%. Canada has a higher importance, 13.3%. And China, which is not in the US dollar index, but is in the US dollar trade weighted index, that's just under 14%. So there are some people who view that one as a better way of looking at the dollar. And I'll get into weak dollar versus strong dollar. And just incidentally, the euro area was just over 20%. And compared to, 57% plus Sweden, plus the Swiss franc, plus, Britain. So when, compared to that, I mean, really, it's almost 75% of the currencies in the regular US dollar index are Eurocentric versus the trade weighted, only about 20%. Okay. So that's what that is. And I'll put a link to a chart for the trade weighted index. I'll put a link to the Federal Reserve Bank website that has the current components of the trade weighted, because it's a little bit difficult to find. And the US dollar is easier to find. You can probably find that just by a quick Google search. Okay. So then why do we care about the US dollar? And interestingly enough, recently, I'm trying to find it here. Yeah, here we go. Speculators is a headline in Reuters right at the end of January. And it was speculators up net short dollar bets to largest since May of 2011. So what does that mean? Well, you can look at something like the Commitment of Traders report. So commodity exchanges, they sort of track this. And you can see the value of a short position. Remember, we did an episode a couple weeks ago about, we talked about shorts and things like that. So I'll put that in the show notes. You can certainly check that out. But they tracked that thing, and it was about $34.5 billion in the week ended in January. So that's they're saying it's the largest shorted position. So you're betting against the dollar. You're expecting the dollar to go down, and they don't say it, but I'm assuming they're looking at the regular U.S. dollar index, not the trade weighted. So anytime that you have a really big long or short position, it is interesting. Because we know if let's say those traders or those positions are not right and the dollar swings around, we actually saw the dollar rise again. And I'll talk about how interest rates affect currencies in a second. But certainly any break higher, materially higher in the dollar would see a lot of unwinding of that position. Now, also, people could be hedging other positions by going short the dollar. Remember that, if you own a lot of stocks and you buy, put protection, for example, below the market, it doesn't necessarily mean you're bearish. It just means you want to have a hedge in your portfolio, a floor in the portfolio, but you're really net long. Like you're not necessarily rooting for the market to go down. So I haven't dug into to see anything more than some of the news on the short dollar trade, but definitely that's come about. Okay, so interest rates and the dollar, and really any currency. So last week of February, last week as well, we've seen. I talked about it last week as well on the podcast. You can check that out. There was a historic percent change higher in interest rates. And I said it before, I'll say it again now. 39% or 30 to 40% moves higher in the interest rate, not the bonds, but the interest rate on something like the 5-year Treasury is only, I think it was the second highest of all time. But remember, denominator, numerator issue, right? With rates so low, you could have, if rates were 0.2% and they went to 0.4%, that would be a 100% move, right? But certainly with rates going higher, albeit still very low. One of the things you saw is the dollar reacted, and the dollar has come off its lows and rallied, and kind of a strong rally over this week. And so why is that? Well, one of the reasons is, countries, investors, big institutions, they can sort of decide to park their money in different spots. And if the perception is the US dollar is, going to be increasing, or the spread in the interest rate that the US, let's say treasuries are paying versus bonds of another country, the US starts to become more and more appealing. And so generally currencies over the long term, you'll see them, rise and fall with the spread in interest rates between different countries. That's why they call it the carry trade, where for many years until 2008, 2009, it might have been 2007 when it broke, but there was this powerful New Zealand dollar, which is, everybody calls it the Kiwi, and the Japanese yen, and where you'd be buying Kiwi dollars, New Zealand dollars, and selling yen in the process. And it was called a carry trade. And the value of the Kiwi against the yen continued to go up and up and up for many years. And all at the same time, institutions had this trade on, since the interest rate on the Kiwi back then, I think it was somewhere around 7%, and it was virtually nothing on the yen, you actually had a situation where it's called the carry, because the carry it's a positive carry, meaning you're being paid the difference between what you pay on your short Japanese yen position, which is next to nothing in interest because you owe the interest, and then what you get on the Kiwi dollars. And there's a spread in between there. So, if you're looking at interest rates, it's not necessarily what you see in the Wall Street Journal. There's spreads involved. Take a little bit off each side, things like that. But, that was definitely a very powerful trade. And so interest rates going up relative to another country is certainly a big deal. And that could impact, what you're seeing from, for the value of the dollar. So the other thing too is that, and this is why, the trade weighted, or you sort of got to look beyond just the dollar index. But it is interesting because, emerging market currencies, when they get really weak against the dollar, historically that's been an issue. And the reason why it's an issue is not every country borrows in their own currency. So you think, okay, so if you're a U.S. corporation or the United States issuing treasury bonds, what do? Well, okay, you issue U.S. treasuries, they're in U.S. dollars. If the dollar goes up, dollar goes down, you have to pay out the interest payments on this in the same currency as it's denominated in. But take Turkey, for example. Turkey, I believe a couple of years ago, they were under some pressure because they borrowed money. So the government of Turkey borrowed money, but not in their own currency. They basically issued bonds in U.S. dollar-denominated bonds instead of the Turkish lira. And so if the Turkish lira gets really weak against the U.S. dollar, it takes more lira to go and buy, to pay the interest. So imagine, you issue a bond and let's just pretend it's $1,000. I know they probably did billions of dollars or millions of dollars. But let's say you issue a bond for $1,000, and we'll use the euro, right? So let's say you're in the U.S. and you issue, you're in Europe. You're a corporation. You're let's say the European Central Bank, and you issue $1,000 euro bond, but it's dollar denominated. So that means you owe the interest payments in dollars. Well, if the euro goes down to, 50 cents to $1 US, that means, if you want a dollar, you now need 2 euros, right? So anyway, so hopefully I'm explaining this correctly. but it means they have to come up with more euros. I probably didn't do a good job of that, but hopefully you get sort of the general idea of it. It's just if you borrow in a currency not your own and your currency gets weaker, it's problematic because you have to come up with more of your own currency then to make the interest payments. And so that's one of the reasons to watch the EM markets in particular. Now, with a strong US dollar, there's sort of good news and bad news, right? So a really strong US dollar, the easy one is, hey, you can travel different parts of the world and your money's going to go a lot further. Anyone who went to Europe when it was close to, 2 to 1, it was, you buy dinner, your $20 dinner is really like $40 US. So that's a positive. Imports become really cheap. So if you're buying something from a foreign country and the US dollar is really strong, well, it doesn't take as much US dollars to pay for that. So, that's pretty simple, right? US dollar, also a lot of commodities most commodities are priced in US dollars. It's just how it is, right? So when there's a very, very strong US dollar, in theory, some of the cost to buy commodities might be cheaper for the US, more expensive maybe for other countries. So, that's sort of the good thing. The bad thing about a strong US dollar is that our exports are probably going to go down because guess what? Everything that we export is now going to be much more expensive to those outside the US. And this is kind of US centric because that's where I am. But, if you're making BMWs in Germany, not like we have the German marks anymore, but, if the German mark was, thinking back in the day, went up 10 times what it was, all of a sudden that BMW becomes 10 times more expensive. So you're probably not going to sell as many of those, not going to export as many. So it's, and then the other thing too is the general thought is that weak US dollar, good for stock market, and it's good for multinational companies because when they're selling their, the goods all over the world, the weaker the US dollar, the more demand for their products is. And so in that way, you'd rather have a weak dollar. Now, with a weak dollar, other countries' stuff gets really expensive. So it's could be, I don't want to say it's somewhat inflationary because it goes back and forth. But if you want to buy, let's say, a TV, or I was going to say a stereo. Does anybody buy stereos anymore? Probably not. Or you want to import French wine or some food that's grown in in Malaysia. Isn't what food is grown in Malaysia? That's there's that. It almost looks like a watermelon. Dragon fruit. Is dragon fruit, or is that Thailand or Vietnam? I forget. There's a sticker on the thing at the grocery store I've seen. So anyway, if the US dollar gets really weak, those things become more expensive. They become much more expensive. So, that's problematic. So, there's good things and sort of bad things you can look at with a currency going up or down. And I mentioned the impact on corporations. So specifically to multinational corporations, if the dollar drops in value, as I said before, the goods that are priced in dollars, those sort of increase, and those imports become much more expensive. And so if you're a company, you've got to import all of your input cost. Yeah, import your input costs, right? So the stuff that you use in the plants and the machines, and if you're buying something from overseas, it's an input cost that's going to rise. So I mean that certainly in the past, it can certainly affect earnings. And then the other thing too, I would say, is that with regard to the dollar, it's so the U.S. dollar has, quote unquote, this special reserve status, meaning it's the reserve currency for the world. But typically in cases where we've seen really bad inflation, it's when the country's own citizens or other countries or investors, whoever, they sort of lose confidence in that country's currency. And so once somebody loses confidence in the currency, they don't want it. And they view it as only going down. And so there's been people over the years who have said, look, all this national debt that's going up, I thought the debts and deficits were an issue in the 80s. Apparently they weren't. Maybe one day they will. We just added about 30% to the money supply. Although, as I've pointed out, money velocity has not gone up. It's at all-time lows, at least going back to the early 60s. But that's the confidence part of it is important. And so if a country's currency sees confidence diminish, that usually breeds more and more weakening of that currency. And only if they're able to set up a facility where they have some sort of guarantee of an exchange rate into U.S. dollars or some other, they did that in Chile. You can Google currency board for how they fixed the Chilean, I think it was Chile, Chilean inflation problem. It might have been Argentina. I gotta look that up. But you can Google one of those. The IMF has a paper on that. So, all right. So we covered a lot of ground there, and hopefully that makes sense. And we sort of get an understanding what the indexes are, what the different aspects of strong dollar, weak dollar, why it's important, the reserve currency. And so it kind of sum it up, a strong dollar basically means, look, U.S. goods, more expensive, foreign markets. But great, we can import stuff. It's pretty cheap. We can get cheap stuff. And the problem for U.S. companies, especially global companies, is that their earnings may be hit. And I'm not saying, if the U.S. dollar index goes up a little bit, there's other things that can offset that, but all else equal, right? Because they're not able to sell as much U.S. products and services overseas. And depending upon, the climate, companies might decide to move jobs outside of the U.S. Because it becomes much, much cheaper with a strong dollar. And obviously with a weak dollar, stuff is, goods, services, stuff in the U.S. is less expensive to people in foreign countries. The imports get more expensive. That's obviously, a con, I guess. But here's the good thing. Really, the U.S. companies become a lot more competitive globally. And because it's just, obviously they can, the goods and services aren't as expensive, right? And so the other thing to keep in mind is that, at least as was reported, there's a large short position betting against the dollar. We'll see how that plays out. It's always interesting when one side of the trade gets a lot of play. And the other thing to watch too is this whole seesaw with interest rates, the U.S. dollar, because there's a lot that goes into this, but in a weird way, if the U.S. dollar were to get really, really strong and the perception is that the U.S. dollar will continue to rise, it actually could help keep interest rates lower, because that would mean a lot of foreign buyers would come in and purchase treasury notes or treasury bills. And because the interest rate, right, is more attractive on a relative basis, but the perception is, hey, let me go to the currency that's going to appreciate against my own currency. And we know more buying in bonds prices go up, interest rates go down. So I'm not saying that's going to happen, by the way, just to be clear. But certainly that's sort of a corollary. And by the way, if you have a really strong dollar, typically that means things like fuel are less expensive because they're priced in US dollars. So anyway, that's the podcast for this week. Remember, please, you can rate and review and star and do all that stuff. But please share this with someone who you might think would enjoy it or benefit from it. And now you know a little bit about those dollar indexes. All right, we'll talk to you next week.